3, 2, 1. Welcome to the show on this holiday weekend. Hope everybody is being safe and remembering what the holiday is all about.
Absolutely. In between the burgers and dogs, got to raise a glass to the guys.
I'm feeling a little sniffly today, so if I don't talk as much, I know you guys will be happy. And Jerry won't, because he likes to have a break.
I'm trying to stay on the other side of the table because I don't want to catch whatever you got.
No, it just came on like a freight train last night, but we're going to suck it up, drive on.
That's exactly what we do.
All right, what you got?
TSP Weekly Update. No, TSP Weekly Podcast. 28 May, end of May. Wow, can't believe it. All right, so we're going to do... this is kind of a little bit different today, but there were two guys that I want to kind of talk about: Stanley Druckenmiller and Warren Buffett and Charlie Munger, kind of as a duo. But
we can't just fly by that name. Come on, man.
We're not going to fly by. We're going to do little intros and things.
I like that.
Druckenmiller, yeah. So we'll get into it a little bit. The Wikipedia page on him, but he was George Soros's right-hand man when Soros made like ridiculous gobs of money in the late 80s and 90s, I think. It says it on Wikipedia. But he was the lead fund manager for quantum investments that was Soros's fund. So, he's a legend, Druckenmiller. So he did a keynote speech at USC Marshall that we're going to kind of look at. This is the link to it. Then this was in May this year, so a couple weeks ago. And then an event up in New York called the Sohn Conference. This is the link to that. They're both definitely worth watching, and I'm going to kind of pull out the highlights from what he was talking about at each of those different events. And then the 2023 Berkshire Hathaway Annual Meeting was in May. And this first link is to the 5-hour-long kind of Q&A session that Becky Quick from CNBC did, and there are a bunch of people in the audience. It was the whole, it's I don't know, it's like 3 or 4 days. It's like
5 hours. Yeah,
but that link goes to a 5-hour video of all that was going on. I mean, it's like a return to Mecca basically for the Berkshire annual meeting.
Right.
You have to be a shareholder.
Grab a cup of coffee and soak it up.
Yeah, it's worth watching. So we're going to go through the highlights of that. Actually, what I'm really doing is the highlights of this link, because this link is about 45 minutes, and it's a distillation of the 5-hour link above. So definitely check that out. And then if you really want to just skip to it all and get the Cliff Note version, Wealthion had a discussion, like a roundtable discussion about all of this in their video at this link. So it's all worth watching, because they're legendary people that are talking about how they think the market's gonna go going forward, the concerns that they have, and some of the possibilities of what they see. So, and then we're going to do the bonus chart is going to be the VIX, the volatility index, and then we'll do the weekly TSP Fun Charts. So Stanley Druckenmiller. He's an American investor, hedge fund manager, philanthropist. So he was the chairman and president of Duquesne Capital. That was his company, which he founded in 1981. Closed the fund in 2010. At the time, Duquesne Capital had over $12 billion in assets. But his big claim to fame is from 1988 to 2000. He managed as the lead portfolio manager for Quantum Fund, which was George Soros' fund. George Soros is a pretty controversial name, but from our perspective, he was able to make ridiculous amounts of money in this Quantum Fund, and Druckenmiller was the lead in that. So Druckenmiller he absolutely knows what he's talking about and what he's doing, and when he does these events, people really pay attention to it. So the first one was the Sohn Conference. And he's saying this is by far the most challenging market environment of his 45-year investing career. I mean, that's saying something from a guy at this level to and he's not the only person that I've heard that's very reputable, both money managers and fund managers, and economists, and it's a very, very challenging environment. And so if you don't know which way to go with your TSP funds, don't feel bad. You're not alone. So he's advising investors to be conservative, basically sit out this environment in cash and treasury bills. I mean, that's his general advice. He says the worst economic outcomes follow asset bubbles, and we're in the worst asset bubble in world history. There's no shortage of people that have that opinion. The stock market, the real estate market, and the bond market. The worst bubbles in history. Arguably, the bond market has fallen quite a bit because we did have the biggest drop in history in 2022 in the bond market. But I think you would also add crypto into that mix of bubbles. But he went back 500 years, right? So not just to the 1950s, as we sometimes refer back to, whatever. 500 years going back. Interest rates falling below 2% is going back 500 years, interest rates falling below 2% result in very bad economic outcomes. So we have that's going back 500 years. So when we say that rates have been basically zero since 2009, going back 500 years, rates below 2% always causes big economic problems. And we're just in the early stages of all that happening. He's highly critical of the Fed, keeping interest rates as low as they did as asset prices skyrocketed in 2021. He thinks the likelihood of a soft landing is basically zero. He expects a hard landing with a 20% or more decline in corporate profits, which doesn't directly translate to a 20% decline in the stock market. It's actually worse. And an unemployment rate above 5%. So this would be a big one. If we get unemployment above 5%, the Fed's doing its job because it's trying to drive up unemployment at this point. But that would certainly, 5% is something we haven't seen in a long time, and stock prices would go down quite a bit. And he thinks we're going to see wider bankruptcies throughout the economy. So not just banks. We had 4 of the 5 largest bank failures, I think, in history, happened in the last couple of months. And obviously the market's shrugging it off, but it doesn't mean that those problems go away, All right, so those are the highlights from the Stone Conference. So he's completely switching gears here at the USC Marshall commencement speech, because he's doing this commencement speech at Marshall Business School. And so he's talking to, people that are in their early 20s. And so, of course, what he's focusing on is directed to them. So he's saying, if nothing changes, pensions tomorrow will be a fraction of what they are today, and the government won't be able to pay for more than half of your medical bills. Most of this is about entitlement, and that's kind of the bottom line at the end of it. So entitlement spending is off the charts. Federal government currently spends 6 times per senior versus child in the United States. So, of all the federal funding that goes to childcare and the rest of it, it's 6x to entitlements that are going to seniors. Demographics is our biggest problem because boomers' entitlements without increased workers to pay for it, right? So back when they started Social Security, there were 6 maybe workers contributing for everybody that was taking money out of Social Security. Now it's I don't think it's even yet. I should go back and look at those numbers, but at best it's 2 to 1, two employees to 1. And our senior cohort is rising because the boomers are in that, right?
Right. None of this is sustainable, right? I mean, that's the takeaway. That's the real problem, is none of this is sustainable. So,
well, the workforce participation rate is low, right? Quiet quitting and all the rest of it. Workforce participation rate is low, and declining, and the number of people retiring is increasing, and so it's not sustainable. So he's saying, given the current math, in 25 years, 70% of all tax revenue will go to senior entitlements. 75% of all tax revenue. It's kind of insane. Rising interest rates compounds the problem, right? If interest rates were at 5%, which it basically is now, the federal government would pay interest the size of COVID relief package every year forever. And those are the CBO numbers. They're not numbers that he's making up. Federal spending on healthcare, Social Security, and interest payments, right, on money that we've already spent, is 68% of revenues currently. By 2040, it's going to be 100%. So that means there's no money. That's of tax revenues. So there's no money for defense. All the other stuff that we do, right? Healthcare, Social Security, and interest payments on the debt, and that, of course, only goes up as rates go higher. So that, it's extrapolating the numbers out, and we're not going to be able to get there. But how do you fix it? Like, who knows? So he's saying the only thing that Democrats and Republicans agree on is not to cut entitlements. That's the only thing that they do agree on, right? Nobody politically is willing to say we're going to cut entitlements in any way.
Right.
And what Druckenmiller's saying is it's not a choice anymore. Like you have to do it.
We've gotten past the politics. It's got to be the financial reality.
Yeah.
That takes over.
Yeah.
Yeah. And somebody has to be strong enough to say that.
Yeah. I don't know who that person is, but
we won't
good
get
luck
into the
to
politics
them.
of it. But yeah, it takes a lot for you to be able to come out and say, look, this ain't going to work.
It's not going to work, and you can't print money into infinity because what you're not actually. This is kind of another thing people don't understand. You're not printing money. You're printing debt, right? So the Treasury
That's different.
It's somebody has to buy the debt, and that's how the money, quote unquote, money gets created. You don't just literally print it. You print a thing, a Treasury bond, and somebody has to buy the bond, and now the money is in existence, right?
Mm-hmm.
And if people stop buying Treasury bonds, then either we have a big problem because we can't generate any more, revenue. Yeah, I mean money, or to get people to buy, or countries' pension funds to get people to buy Treasury bonds, you have to give them a higher rate.
Mm-hmm.
And so if the rate keeps going up because they really need the issuance of the bonds, then the government has to pay that much of a higher rate. It's a wicked catch-22, but it's not a choice anymore. So, and he really doesn't like that the Fed has supported these unprecedented asset bubbles, which it's unbelievable. So he's quite bearish. Let's put it that way, long term. And what he's saying to these kids that just graduate from business school is these are giant problems on the horizon that are absolutely going to affect you in your life and society as a whole over the next 25 years.
Yeah, and they got to get out and solve it.
Yeah, I mean, that's what he's basically saying. He's like, hey, we gave you this shit sandwich, and you're gonna have to figure it out.
Not only do you have to eat it, but you got to figure out how to not like it anymore.
Yeah,
because it's not going to be our generation that fixes it. I don't think, because we're just too set in our ways,
Well, our generation. I mean, if we live to 2040, it'll have to get fixed before then. Otherwise, we won't have an army.
What I mean by that is like we talk about this every once in a while, where our kids, our people that are our kids' age, our older kids, right?
Yeah.
In their 20s, 30s, whatever. They seem to be more interested in finances and financial macro and microeconomics for whatever reason. Definitely, I mean, not for whatever reason. We know why. Like, it has become very accessible to go trade, right? So it's cool. And so there's this thing, this huge expansion of people that want to be entrepreneurs, right? Whether they know what that is or not. And this huge expansion of people that are interested in the market. And then when they learn about the market, they learn about other assets and on and on and on. Where that was not our reality at 20 and 30, right? And so maybe that's a good thing, right? Maybe they will get more engaged faster and go, okay, you old codgers, you got to go sit on the sidelines because we got to fix this. And they're also, it seems, the trend is that they're more likely to live with less.
Yep.
right? There, there's obviously, your Instagram people that are
superheroes,
whatever, but like the average person that's 30 now is trying to live a little bit more below their means, at least from what I can see, and I don't have all the.
I mean, they kind of have to.
But,
like the affordability of a house right now is impossible.
Right, it's because they don't have a choice, right? Yeah.
Okay, so Charlie Munger and Warren Buffett. So Warren Buffett doesn't need too much of an introduction. Everybody knows who he is. Currently the chairman, CEO of Berkshire Hathaway, best known as a fundamental investor, one of the best in the world. He apparently now has a net worth of $104 billion as of March 2023, making him the 5th richest person in the world. Charlie Munger has been his partner for pretty much the whole time he's had Berkshire Hathaway. He's vice chairman at Berkshire, conglomerate controlled by Warren Buffett. Buffett describes Munger as his closest partner and right-hand man, and he's done some, a bunch of other things also. But I actually like listening to Charlie Munger more than Warren Buffett. But here's basically the big takeaways from that 5-hour clip. So Becky Quick asks basically 8 questions, and these are the responses to kind of the 8 questions. So she asks about Silicon Valley Bank and would the collapse have really been catastrophic? What Buffett said to that was yes. Silicon Valley Bank, if it collapsed, would have been absolutely catastrophic, and the Fed, / FDIC backstop avoided basically a world banking crisis. It would have been bad. Second question was about AI. Their opinion is that it's overhyped. Now they're old guys, right? But they don't think that AI is going to be replacing the gene. They think humans are not going to let AI run away with everything, which is kind of the fear that's out there right now. There are certain things he talked about. Microsoft. Who's Microsoft? Gates. So Gates takes Buffett out and does a little dog and pony show about how they're integrating AI into Microsoft, and it was pretty funny listening to him kind of talk about that. But they don't think AI is going to be as big a deal or as dangerous a thing to society as a lot of the hype is about. Is AI technology ultimately a good thing? They kind of compared it to the atomic bomb and Einstein, right? Once the technology is out there, it's out there, and it just depends on how it gets used. But it is going to change everything. It's just a matter of whether or not it gets used for good or bad. We look for the easy job we can identify. So they were talking about Elon Musk and how he tries to solve like big problems, and Buffett and Munger kind of look at each other and chuckle, and they're like, "Oh no, we're not trying to solve big world problems. We're trying to identify the easiest way that we can make the most money, and which companies can we buy that are most undervalued, and we can go in and tinker with the management team a little bit and generate the most revenue out of these companies." So it was kind of funny about that. Commercial real estate, they think, is in big trouble. With rates as high as they are, once all these loans start having to get recalibrated, the commercial real estate's in big trouble. There's a lot of talk about the dollar. Is it going to continue to be the world's currency? They don't see any other option other than the dollar continues to be the world's currency, world reserve currency. Charlie Munger did say, and this was kind of a long diatribe that he did, but the bottom line is value investors should get used to making less. What he's saying is everything is overvalued, and which is why they're not really buying anything right now, because everything's in a bubble. And they're saying avoid emotional investment in business decisions. Sometimes it's just not the time to be buying, and that was kind of one of the bottom lines of this 5-hour thing was it's a very tough market. There's nothing macro good on the horizon, and everything is overvalued. So it kind of is the same as Druckenmiller, sit in cash and treasury bills. Like it's a very dangerous time to be playing investment games. Don't make mistakes that take you out of the game or come close to taking you out of the game. So as much as Buffett is touted as this buy and hold, long-term fundamental investor, he came pretty close to coming out and being like, they in reality, they do different. They don't trade like we do. They're not retail investors. They buy the whole company. But what he's saying is don't make the mistake of thinking that the market is going to keep going up and it always comes back and all that, because if you lose enough, it'll take you out of the game. And for us, it's like if you take a 50% drawdown the year after you retire, your world has changed and not for the good. If TSP is a big important chunk of your retirement plan.
Right. And that's what we try our best to get across all the time, right? Yep. I mean, try not to be like, sky is falling negative, but it's the reality is why if you can remove yourself from a depreciating asset, right? Yep. I had to remind someone in our Facebook group a couple days ago the difference between the money they're putting in every month, right? Mm-hmm. Buying shares low. Yep. That's true.
Yep.
But we're assuming the bulk of our money is already allocated to a fund. You're not buying anything.
Right.
That's just an asset that's going down.
Right.
And why would you leave it in that asset and just watch it go down? You're not buying anything.
Right.
And that is sometimes the hardest thing for people to wrap their head around. And it's just strange. I mean, it has to be just, it's not ignorance, I don't think. I think it's just, I don't want to believe it. Right.
Yeah.
Because all these other things tell me that this is what it is. For years we've heard this, but we are applying, brokerage account methodology kind of thinking, buying stocks and the brokerage and all that to like our retirement account. It's not the same. It's not the same.
The environment is different. I mean, I just posted something on Facebook the other day, and I think it was the market update. I think it was the market update. So we put out a market update to our subscribers, and I think we're going to put it out to the Facebook group next week. But the thing is basically interest rates. So interest rates topped in the early 1980s, and ever since then, the market has been in rally mode. And there's been some corrections along the way, obviously, but things are different now, primarily because now the direction of rates is up. It's not down. And it's not just a blip on the radar. Like I'll put the chart up again. I've done it before, but I'll put it up again. The 10-year yield bottomed out in like 2000 and is in a 5-wave Elliott count up, and rates are going higher. They're not going lower. And so if you understand that, what that means is less liquidity in the system. It's the inverse of what we had, the conditions that we had in this huge bull run that we've had since the early 80s. So to think that the same market, you're going to get the same market returns when interest rates are going higher is either to just to choose not to believe it. And if you do, I mean, there's plenty of people that think, the market always goes up and we're a bunch of knuckleheads, and that's fine. But the reality is things are different than they were 5 years ago, and it's not going back to where it was. We're going to get giant spikes. I mean, eventually something will break. The Fed will probably almost definitely cut rates, and we'll have all kinds of other things happen, and we'll work through that as we do it. But buy and hold during this environment is just not a good idea. All right, so I'm not going to. So again, you can go to the YouTube link and see what Adam Taggart at Wealthy On, and then he had John Ludra and Mike Preston from New Harbor Financial, and they talked about what their takeaways from the Druckenmiller and Buffett and Charlie Munger. All right, bonus chart, volatility index. So a lot of people talk about the VIX. It's a pretty good guide for certain things. Lance Roberts at realinvestmentadvice.com put up this chart last week, and basically it's going back to 1990, and what he's saying is this green line right here is 16 on the VIX. And so the chart shows you the S&P 500 in blue, and when the VIX is above 16 in orange and below 16 in green. So when the VIX is low, it's a fear index. So when the VIX is low, stock prices tend to rise. When the VIX is high, stock prices tend to fall. But there are big chunks of time where VIX is high and the market goes up, right? We focus on the times when the VIX is high and the market goes down. But so this is a kind of a big picture chart. And I thought the concept was valuable, but I kind of liked it better when I did it on TradingView. So this is the same idea. This is the same VIX data, and the green line is still 16, right? But I think it's a little bit easier to see. We only go back to 2009. We get a big spike in the VIX as we bottom into the bottom of the financial crisis, right? Which is to be expected. And then when the VIX is falling, it doesn't really matter how high it gets. When the higher it gets, the more likely you're close to a bottom, because that's the peak in fear, and that tends to be the bottom. Whatever height it gets to, as the VIX starts to fall, the market goes up. Like, that's how it works. So we got a spike here in 2010. This was kind of this part right here. And then as the VIX starts falling, the market rallies. We had a spike in the VIX. When the market falls, as the VIX starts falling, the market rallies. And then when the VIX is below 16 and it stays down there for a long time, this is the long extended bull market, right? That's what you really want. A low VIX for a long time, and the market just keeps on moving higher. So the VIX is good to follow. If you're going to actually use it as a trading tool, the biggest thing is to look for places like this. When the VIX starts, it's at a bottom for some amount of time, right? It's kind of bottomed out here. And then it starts to turn higher, right? The VIX was anticipating something happening. It started turning higher before this big fall in COVID, okay? And this, obviously, we had a big spike in the VIX when COVID actually happened. But the VIX will anticipate changes in the market. We were going to have a recession back here. Not too many people talk about it, but it's very likely that if we didn't have COVID, we would have gotten the 20% decline that we got in 22 back here in 2019, 2020. But we didn't. We had COVID, and then we had this giant supply of new capital coming into the market, and that gave us this monster run-up as the VIX started falling off. The only other thing that's pretty interesting about this is that for all the negative sentiment and pessimism and everything else, there's all these metrics that you can look at. The VIX has been in a downtrend. It actually peaked at the top in 22, right? In January 22. And yeah, it came down, and we get a spike in the VIX. Then prices rally, the VIX comes back down, right? Market goes down, VIX goes back up, but it didn't make new highs. And so the trend in the VIX is down as price is coming down, which is odd, right? That's number one. Number two is we don't have a big spike, something like above 50, right? So COVID, it was terrifying, right? It's above 80. But 50 is kind of the line where big bottoms happen, okay? We didn't get anywhere near that all of 22. So there's not a lot of fear in the market. I don't know if it's the buy the dip mentality and all that, but we just never got the capitulation that everybody looks for to identify a market bottom. And we had a declining VIX. It's amazing. And so it goes to the idea that this is just a correction to this down move, and the next move is down. I mean, there's so many technical and fundamental reasons for the market to go lower from here. I just cannot overemphasize the conditions that we're under. At the same time, as we're going to go to next, the market is moving higher. So I'm going to put out Michael Pinto. He's on Wealthy On sometimes, and he's great. So he's a money manager, and so is Neil Roberts that does the weekly show on Wealthy On. But most of the interviews that Adam does are with macroeconomists. Most of them aren't money managers. And so if you're a macroeconomist, you might be really good at it. I mean, he has great people on there. And they have very compelling reasons why they think the market's going to go in one direction or the other. But at the end of the day, the money managers have to be as knowledgeable or close to be as knowledgeable as these guys that think and talk for a living. But they also have to manage people's money. They have to make decisions about this stuff. And so Pinto was on. He's got an algorithm basically that tells him what sectors and asset classes and things to be in different environments. And Adam was asking him like, well, you know, you're in. I can't remember what he's in right now. I mean. It could, because we're in one of he's got 5 sections and we're in one of the 5, and he's talking about how we're going to go into the next one. And he is very bearish. But he's not short yet. So we TSP is long only, like you can't short anything in TSP. But if you are a real, money manager, you see that the market is going to go lower, you sell short, right? You make money when the market goes down. He's like, everything in me is screaming to sell short, but my algorithm is saying that now is not the time, and so he's not buying a lot. He's I mean, we're 50% in the stock funds right now. He's definitely not 50% in equities. Our game is a little bit different than his, and we can kind of move on a dime basically. But right now, the market's moving higher. But everything in him and me and a whole bunch of other people are saying it should be going lower from here, and just stand by for it to do that. All right. TSP Fun Charts. So, like I said, the market keeps going higher. So we I didn't do the 3, or I usually go back to just before COVID to kind of get a broader perspective, but this time I just wanted to go basically to the top here in January 2022. So each one of these ticks is a week of price action. So if you're just watching the podcast here every week and you only want to manage your TSP on a weekly basis, which is fine, this is what you would do. And actually, we had a comment on Facebook today, I think. So what is today? Friday. So I put out the market this week slide that I do every week, and somebody commented like, "This, it's such a crazy market. How can you possibly have a plan?" And I'm like, "Well, watch the podcast, because we tell you exactly how we do it every week, right?" So here's how we do it. You got the 20-week, because this is a weekly chart. You get the 20-week moving average line in blue. You got RSI, which is relative strength, down here, and MACD down here. So a very simple plan, regardless of what the market's doing and all the macro stuff and everything in Wall Street Journal and everything else. If price is above that 20-week moving average line, and RSI is above 50, and MACD is positive, the odds are that the market continues to go higher. And so on a weekly basis, we got a buy trigger right here. This week right there, that candle. Okay. And we haven't had a sell trigger since. Because MACD never turned back negative. Yes, we got below 50 here on RSI, but even that, it only got down to 45. Like, it didn't get very far below that 50 line. MACD didn't turn negative. So this buy trigger was in place on a weekly basis and is still there. So you could have, if you did that, you would have gotten back into the stock funds at that level right there. Now, yes, the market has gone up, but in reality, you haven't made a whole lot because the market really hasn't made a whole lot. So, at any rate, we get. Was that me? That is me. I'm supposed to be posting that slide. All right. So that's how you do it. You when price rises and gets above that 20-week moving average line, RSI gets above 50 and MACD crosses positive. When all those things are in place, that's your buy trigger, and the opposite is the same. So this was our sell trigger at the top on a weekly basis in January. RSI gets below 50, and MACD had already turned negative. So that's how you do it. And for our subscribers, we do it on a daily basis, but in the podcast, we're showing you how you would do it on a weekly basis. And so where are we right now in the C Fund? It was an unbelievably volatile week. So one of the advantages or disadvantages, depending on how you look at it, you can see that the market opened at the bottom of this rectangle, came all the way down here, got lower than last week's lowest price, and then on Thursday and Friday came all the way back up, and we closed positive for the week, and we closed above that 4,200 level. So this is a really, really bullish candle on a weekly chart. But this week was gut-wrenching if you were watching it on a daily basis. There were a bunch of people on Facebook that are like, got a sell signal, why aren't we getting out? And, I take a lot of things into consideration before making a reallocation, and, it was pretty much laid out in the last alert for what it would have taken to get me out of the stock funds. And so you can't get spooked out on individual days that go down if the triggers aren't met. We would have missed it, and we'd be out, and we'd whatever. Okay, that's the C Fund. S Fund not doing as well, and honestly, this is a serious concern. The reason the C Fund is doing well, and if you look at the NASDAQ, it's doing way better than the C Fund. There's like 10 companies that are driving the market higher, and they're all in tech. They're in the NASDAQ, and they're also in the S&P 500, but they are not in the small cap index, which is what the S Fund is. And so what this chart is telling you is that the rest of the market is not participating in this rally. The C Fund is going up, that's fine, but the rest of the market is not participating in the rally. It's just not. And so from a technical analysis perspective, you have left shoulder, head, right shoulder, and this neckline. If this thing gets broken to the downside, the S Fund is going much lower. There is no doubt about it. Having said that, we could look at it like, okay, this is a smiley face on a longer term, and the market goes higher. Yes, that's a possibility, and it's why we are partially invested in the S Fund right now. But if it breaks that line, everything changes. Okay. I Fund. We were talking about the I Fund and the dollar. I posted something about that last week, the week before. I Fund is in trouble, I think. I think the dollar moves higher, and when the dollar moves higher, the I Fund definitely moves lower. It got support. That was on Friday, because we were down here on Thursday. We were right at the line, at the 20-week moving average line. Recovered a little bit on Friday, which is great, but RSI not below 50 yet, but clearly below. It's rolling over, and MACD is just about to turn negative. So we get one more negative week and get down here below that 20-week moving average line on the I Fund, and it's the next target is this low, and if it gets below this low, it's retesting the October low. F fund. We've been saying the same thing here for quite a while. The experts thought that, or still think, that this is an historic bottom in bonds, and it may turn out to be true. It's possible that you do an Elliott wave count 1, 2, 3, 4, 5, and this is a major bottom, and this is going to be one ABC for 2, and then this is going to keep going. That's the bullish interpretation of it. My count is 1, 2, 3, 4, 5. That's what I think happens, but we shall see, and it doesn't really matter what I think, because right now we have a very clear sell signal in place on the F fund. So forget about what you think is going to happen with rates and what you think is going to happen with all of the stuff, and does the debt ceiling and like all the rest of it. All you have to do is look at the chart and go, okay, if you're below the 20-week moving average line, RSI is below 50, MACD is negative, you don't want to be in that fund. It's as simple as that. Questions?
As always, if you have questions, you can hit us up in the comment section wherever you find the video. If there is no comment section, shoot us an email at support@growmytsp.com, and they will send it over to us. We hope you guys are having a safe and good Memorial Day weekend, and we shall see you next week.
Sounds good.
All right. Take care, guys.